Many investors are reluctant to invest in currency markets because they feel that the returns provided by currencies are too unpredictable. Yet currencies are influenced by the very same performance drivers that affect many other financial assets: valuations, fundamentals, and investor flows. In this video, we will take a high-level view at these major forces that explain returns in the currency markets. The most well-known valuation method for currencies is probably absolute purchasing parity, also known as the law of one price. This theory argues that the prices of the same products in different countries should be equal when they're measured in a common currency. A light-hearted yet famous example of absolute PPP is the Economist's Big Mac Index, which compares the prices of a Big Mac sandwich all across the globe. Depending on how expensive or cheap a Big Mac is across the world, one can infer whether a currency is currently cheap or expensive. A more dynamic version of the absolute PPP theory is the relative PPP theory. Relative PPP states that for the law of one price to hold, currency exchange rates should move in lockstep with inflation rates. So for example, if inflation is 3% in country A and 0% in country B, country A's exchange rate should fall by 3% over the course of 1 year to satisfy the law of one price. Assuming both currencies were at fair value at the start of the period and exchange rates did not move during the year, according to relative PPP, currency A will be overvalued by 3% relative to currency B. An extension of the relative PPP valuation model is a currency's real effective exchange rate. Like relative PPP, the REER adjusts a currency's value for inflation differentials between currencies. But while the PPP measure compares one currency to another currency, REERs compare a currency's value to a basket of other currencies by considering the entire bilateral relative PPPs between the country and its trading partners, weighted by the respective trade shares of each partner. PPP and REERs are often used as the fundamental building blocks for more complicated multi-factor currency valuation models. For example, Deutsche Bank published a model which starts from a currency's real effective exchange rate and then proceeds to make other fundamental adjustments to take into account changes in a country's terms of trade, GDP per capita, and also how exposed a country's economy is to the global economy. The model then ranks the currencies from the most overvalued to the most undervalued, as the chart shows. Fundamental factors can also have a significant impact on currency performance. These are, for example, economic growth and inflation, political and economic conditions, trade and current account balances, public debt, terms of trade, money supply, and of course, monetary policy decisions. Some currencies are also quite sensitive to specific factors. For example, currencies like the South African rand, the Australian dollar, and the Canadian dollar are known as commodity currencies as they are closely related to fluctuations in energy and commodity prices. Currencies like the Swiss franc and the Japanese yen are known as safe haven currencies and tend to do well when there is a market downturn. Fundamental and valuation factors tend to be more long-term drivers of currency performance. In the short term, currencies are often more significantly affected by supply and demand and portfolio flows. For example, investors will tend to allocate capital to currencies with higher interest rates. The divergence of US dollar and euro interest rates was responsible for a large part of the dollar appreciation from 2014 to 2016. Other investor flows, such as foreign direct investments and portfolio and speculative flows, have historically also played a big part in currency movements. Overall, there are a multitude of indicators that can explain fluctuations in exchange rates, and predicting these is indeed quite difficult. What has been shown is that more knowledge and understanding of market conditions and their implications for currency fluctuations can lead to more accurate predictions and potentially significant generation of alpha.